President Trump's big, beautiful tax bill was passed the House and was signed into law by July 4th, 2025. Today, I want to show you how this is impacting retirees because the effects could be substantial for years to come. Now, there's a lot packed into this bill, and I'm not here to dive into every detail or policy twist. Instead, I want to focus on one key element that can make a big difference for a lot of retirees in my audience, and that's the extension of the larger standard deduction. And we talk about it a lot, but we never get into the difference that really makes. And this matters because the potential tax savings, they aren't small. For many of you watching, the cumulative impact over retirement could be significant, right? Depends on how you define significant, I suppose, but it can be large. And so today, I'm going to walk you through a real-world example towards the end of this video to show you exactly what that difference could look like. Now, between where we are today and when this law has eventually started affecting your tax, it's likely to change a lot. So, if you want to stay informed, you really should subscribe if you haven't already, because I plan to stay on top of this because this one matters. So let's rewind and make sure we're all on the same page about what changed back in 2017 when the original version of this law that they're now trying to extend it originally passed. So one of the biggest changes was the doubling of the standard deduction, which is a move that simplified filing for a lot of taxpayers. But at the same time, the law also eliminated personal exemptions, which used to reduce taxable income based on the number of dependents in your household. But this law was never permanent. It came with an expiration date of December 31st, 2025. And that means that at the end of last year, the larger standard deduction should have disappeared and personal exemptions should return. But, and I'll show you this in a moment, for most retirees, that swap actually means higher taxes. All this talk about expiring tax cuts has created a lot of uncertainty in retirement planning, because up until now, we had to assume that the law would sunset and the old rules would come back. But with this new bill gaining traction now and with who we have back in the White House, it's starting to look a lot more likely that the Trump-era tax cuts, including the standard deduction, could stick around for a bit longer. So, to make sure we're all on the same page, let's quickly break down how this tax formula works. So, you start with your total income. So, everything you earned over the course of the year. Then you subtract your above-the-line deductions, like contributions to health savings account or a traditional IRA. And what you're left with is your adjusted gross income, or what we typically just call AGI. And then from there, you subtract either your itemized deductions or the standard deduction, whichever is greater. And this is a key step because the standard deduction is the amount of income that the IRS lets you automatically exclude from taxation. No forms, no paperwork. It's like a built-in tax-free zone that shields a chunk of your income from federal taxes. Now, here's where things could change. If the Trump tax cuts expire, the standard deduction would shrink, but personal exemptions would return for those who are under the income limit. And in 2017, I believe that income limit was around 400,000, maybe just slightly over that if you were married filing jointly. So at this step in the formula, you'd be subtracting a smaller standard deduction plus an exemption amount for each person in your household, but together, they still wouldn't be as much as the current standard deduction for most retired couples. So let's look at an example to make sure that this is clear. In 2026, under the current law, a married couple filing jointly can deduct $30,000 right off the top, and if they're both over 65, they get an additional $3,200,600 each, bringing their total deduction to $33,200. That means that just over $33,000 of their income is completely shielded from federal tax before we even get to any of the other deductions or tax credits. And after subtracting that amount, whatever remains is your taxable income. So if they had an adjusted gross income of $100,000, only $66,800 would be subject to federal taxes. So now that we understand how the standard deduction fits into the tax formula, let's look at the amount of tax-free income and how that compares under two different scenarios. So let's look at one where the Trump tax cuts are extended and another where they expire, returning us back to those old rules. So, in the green, you'll see what the standard deduction would be for a married couple, filing jointly based on some moderate inflation assumptions if the current law is extended. And then in the red, you're looking at the combined value of the standard deduction plus personal exemptions under the pre-Trump tax cuts rules, which is scheduled to come back in if these tax cuts sunset at the end of this year. And as you can see here, there's a sizable gap between the two. And just a side note here, this chart does not include the proposed $4,000 bonus deduction that's part of the legislation. So if that's passed, that bonus would apply from till 2028 for those that are under the income limits, and that would make this difference even larger. Now let's zoom in on just how big of a difference this really is. If the Trump tax cut sunset, then starting in 2026, most married couples filing jointly would see their tax-free zone shrink by nearly $10,000. And over the course of retirement, that gap continues to widen. And by the later years of retirement, the difference in that tax-free zone could be $20,000 or more, depending on how inflation plays out. Now, it's one thing to see a gap on a chart, but what does that actually mean for a wallet, right? Your bank account, how much you have to pay in taxes. Well, let's break it down and look at how much more in actual taxes a typical retiree might pay if the Trump tax cuts expire versus if they're extended. So, in our example, we're going to look at a married couple who are retiring at 65 in 2026. They have $1 million in a pre-tax IRA and $300,000 in a taxable brokerage account. Now, together, they get about $5,000 per month in Social Security. And when they file their taxes, they don't itemize deductions. They just use the standard deduction. Now, for the first few years, they're able to completely avoid paying federal income taxes. And that's thanks to a smart withdrawal strategy and the tax-free treatment of some of their Social Security benefits. But eventually that changes as they start drawing more from their IRA and Social Security becomes a larger part of their taxable income. Now take a look at this chart. It shows their estimated cumulative federal tax liability under two scenarios. One where the Trump tax cuts are extended, and another where the tax law reverts back to pre-208 rules. Now, this is a big difference. Just 10 years into retirement, this couple would pay nearly $32,000 more in cumulative federal taxes if the Trump tax cuts expire. And if you stretch that out and look at year 25, that difference is now six figures. It's right at $100,000. And that's additional taxes paid simply because the standard deduction shrank and the old rules came back. So, as you can see, this isn't just a harmless policy debate that they're having in Washington that likely won't have any impact on you. It will have an effect on you and the amount of taxes that you pay in retirement and how you strategize your retirement income plan. And whether or not the Trump tax cuts are extended, it's going to affect everything from not only how much tax you pay, but how much tax you pay on Social Security to how much you plan in IRA withdrawals and even if you should consider doing Roth conversions. That's why staying ahead of these changes and building some flexibility into your retirement plan is so important. So if you found this helpful, don't forget to subscribe to this because as this bill moves through the Senate and these details evolve, I'll be keeping you updated with clear insights every step of the way. Thanks so much for watching.